Welcome back, everyone, to my world of stocks, and welcome back to my weekly stock market update series. In this week's episode, we've got a leading economic indicator showing that we may possibly be in a recession already, so we'll talk about it. We also had some big earnings reports this week from some giant retailers, some of the biggest in the world, including Walmart, Target, and Alibaba. So we'll run through those. We'll see if there's any correlation there with the macroeconomy and see how they're being affected. And as always, we'll also run through the biggest gainers and losers for the week, and I'll let you know if anything catches my eye there as well. Hope you're all doing well. I hope you're excited for today's video and this week's update. But with that said, let's just go ahead and jump straight into it. All right, and starting here first with the markets, of course, we know that the previous week, the one before this one, the stock market rallied higher by a pretty large amount, and that was because we had an inflation report come out showing that inflation for October was actually a little bit lower than what analysts were expecting. And so Wall Street took that as a sign that maybe the Fed will ease up a little bit on their rate hikes if inflation is starting to get under control, and thus stock prices went up for that week. But going into this week here, this past week, we actually had a small correction downward from that initial jump the week prior, as the Dow Jones was just about flat for this week, but slightly negative. The S&P 500 fell about 0.7%, a small little dip there this week as well. And then the tech-heavy Nasdaq, of course, saw the biggest correction of all, falling by over 1.5% in what has been a very heavy crash for tech stocks all year long, with the index losing about a third of its entire value from the top. Turning over to market and economic news, though, it was mostly negative overall, as the October housing market report just released, showing that home sales continue to fall for the ninth month in a row, as higher interest rates are making home loans more expensive, and thus it's getting harder for Americans to make those large purchases. In fact, mortgage rates are now at the highest level in over 2 decades, and as such, the Federal Reserve Bank of Dallas is warning that home prices could crash by as much as 20% if the Fed isn't careful enough with their rate hikes, noting that they need to cautiously deflate the housing bubble rather than actually bursting it, which would, of course, cause even more damage to an already very struggling economy. Speaking of which, the economy may already be in a recession, at least according to one leading economic index that was released this week, which tracks the cycles of business activity. And in the month of October, it fell for the 8th month in a row, to which the senior director of economic research where the index is published said that this is now signaling a likely recession to start at the end of this year and last about halfway through next year, and also noted that the recession may have already started as the persistent rate hikes from the Fed are starting to weigh on consumers who are already dealing with record high inflation. As you'll recall, we had a very short-lived recession around the start of this year, as Q1 and Q2 both suffered a negative GDP drop before seeing a modest recovery in Q3 of over 2%. However, with interest rates as high as they are right now, climbing at the fastest rate in 3 decades, with 4 consecutive 75 basis point hikes in June, July, September, and November, GDP may not be looking too good here in the fourth quarter. Now, on the bright side, it does look like inflation is at least starting to get under control, as the growth rate has now fallen in each of the past 4 months, which, if that trend continues, we could potentially see the Fed slow down on those rate hikes, especially as pandemic restrictions continue to be lifted, supply chains get restored, causing supply to get really high at retail stores who are now being forced to put them on discount and on clearance, and you even have political pressure from both sides of the aisle to ease up on those rate hikes. However, I wouldn't get too excited about that just yet, considering that we are still at decades high inflation, and thus I think it's too soon to expect the Fed to really ease up on those rate hikes in a meaningful way, at least not quite yet. Don't get me wrong though, I am very optimistic about the economy recovering over the long term. It's just that here in the short term, there is going to be some continued volatility, but even if we do get a recession here in the short term, most economists think that it will be relatively short lived, only lasting around 2 to 3 quarters. And coming off of that, I mean, stock prices are already so low that I think we would have a decent sized rip in the market to the upside coming out of that. And the economy is already so bad right now. I have to imagine that there would be a recovery on the other side of all of this. So rather than panicking so much about what's going to happen right now and what is the absolute perfect price to buy a stock, I've been focusing more on just having reliable, steady income, having savings, and being able to invest in stocks right now at what I think are already some really attractive prices, but then also having those funds available if we do go into a recession and stock prices get even more attractive. If the economy gets worse but stock prices go even lower, I want to be able to buy even more stocks in that situation. So that's personally how I'm looking at all of this, but by all means, do whatever you guys think is best. Speaking about stocks though, we also had some really interesting earnings results this past week from some giant retailers like Walmart, Target, Home Depot, and Alibaba. So let's just take a quick look at how they performed and how they're doing in this current, pretty bad macro economy, and then we'll wrap up the video with the biggest gainers and losers right after that. Okay, now Walmart actually had a great report, beating on both the top and bottom line thanks to strong grocery sales that are obviously being boosted by inflation, sending their revenue soaring by almost 10% in the quarter, despite it already being a massive more than $150 billion just in that single quarter alone. That's pretty freaking crazy. And as a result, the stock rose by over 5% for the week, leaving it now right near an all-time high despite the broader market crashing. In fact, they're actually positive by a few points so far year to date. One thing that I found very interesting too, though, was that the CFO noted that because of the bad economy, their shoppers are buying cheaper items like hot dogs and beans over more expensive meats. They're also waiting for sale events to purchase more expensive items like TVs while spending less on apparel and home goods that are less essential. So this is a clear sign, guys, that the economy is getting weaker. But it seems as though because Walmart is often thought of as a, more of like a discount retailer, they're becoming a more popular choice among consumers during the economic downturn, and that's really helping Walmart. On the flip side though, Target, who is usually considered to be a little more upscale than Walmart, well, they actually posted horrible results with a 50% decline in profits because of excess inventory that consumers are not willing to buy, and as such, they're having to put them on clearance as a result. Now, on the bright side, this could be a signal that inflation will start to come down as supply increases, supply chains being restored, supply goes up, and demand is going down because of the higher interest rates coupled with inflation. So, that could be a good sign to kind of get inflation under control. But because of the weak results, Target stock continues to struggle this year with another 6% drop this week, bringing their total losses from the top to a massive 40% decline. Now, I'm not sure if this stock is a buy quite yet though. I mean, I do love them long term as a very popular retail chain that even couples tend to go on dates to Target just to kind of shop around together in a clean setting. They even have Starbucks built in. So Target is a very welcoming, kind of nice place to shop. Plus, they have a nice dividend that is starting to look really attractive at over a 2.6% yield with a good payout ratio, a double-digit growth rate, and the best thing of all, over 5 decades of consecutive increases on that dividend. But personally, I would just rather wait to see if that yield for the dividend ever reaches around 3 to 4%, because that's historically where the stock gets really undervalued and then it shoots up to correct it. So that's where I'd really feel more confident buying Target stock even during a horrible economy like the one we're in right now. Okay, speaking of dividends though, Home Depot has always been a popular choice among dividend investors too, and they actually beat on both the top and bottom line this quarter, with sales rising by 6% to a gigantic $39 billion despite the really high inflation and the interest rates that are weighing on consumers. Because of the expected weakness to come in the housing market though, I'm still not really willing to buy Home Depot stock myself, as they depend heavily on homes either being built or renovated for sale using their products and supplies. Although with the stock down about a quarter of its value this year, I can understand why others may want to take a chance on it, as their dividend yield is now about 2.5%, with some fantastic growth metrics on it, like a tiny payout ratio, about a 17% growth rate, and over a decade of consecutive increases. Now, as for a stock that I actually do own myself, well, Alibaba also reported earnings this week, the Chinese e-commerce retailer, and at first glance, it wasn't too impressive, as pandemic lockdowns and restrictions in China have really hurt the e-commerce giant with their shipments, which caused revenue to only increase by about 3% in the quarter. However, investors love the fact that they beat on profits. They're expecting over 30% online revenue growth through the next couple years as the restrictions get lifted and supply chains are restored. And on top of all of that, because the stock has been beaten down by so much already, well, Alibaba has been aggressively buying back their own stock, having already spent $18 billion of their massive $25 billion plan. And they just announced an additional $15 billion getting approved this quarter, which will not only raise their earnings per share, but it also really shows giant confidence from management that the stock is undervalued. They really think their stock is undervalued, and so they're buying up a lot of the stock at these prices, and that's something that investors can always really appreciate. As a result, the stock shot up by over 13% this week, but even after that large jump, it is still down a mind-blowing 75% down from the top, which is really the largest crash in Alibaba that I think I've personally ever seen in the stock. I've been buying it in small amounts this year though, and I plan to continue doing so going forward. Okay, that's going to do it for the earnings that really caught my eye this week. So let's transition now over to the biggest gainers and losers for the week, and then we'll wrap up the video. Now, starting with the gainers first, the best performers seem to be Chinese stocks, including, of course, Alibaba, who saw that 14% gain, but there was also Tencent Music climbing by over 26%, which is the spin-off from the parent company Tencent, who I do own myself. There was also Bilibili and Sea Limited, which are both Chinese video game companies, climbing by over 15% each, and also the online shopping rival to Alibaba in JD.com, who rose by about the same amount as well. All of these companies reported better than expected earnings this week, and that's why they shot up by so much, since they were already beaten down so heavily this past year. Bilibili, for example, is still down 90% from the top. But in terms of an actual investment, well, I would say that Alibaba is really the only one on here that I feel confident to be investing in myself or be betting on it, as most of these are still quite speculative and they tend to struggle with profitability. Other than that, though, the only other stock that really catches my eye on this list, I would say, is Taiwan Semiconductor, which my old school viewers might remember that this Taiwanese semiconductor giant that is, by the way, famous for making chips for Apple, AMD, Nvidia, and others. Well, that used to actually be one of my largest stocks in my portfolio before I eventually sold out of it for a large profit. But this week, they spiked by over 11% after it was revealed that none other than Warren Buffett, the great Buffett, has been buying the stock himself recently at over a $4 billion brand new position in his portfolio for Berkshire Hathaway. And the reason for the purchase is likely due to the stock crashing so heavily this year, right along with the rest of the semiconductor industry, as it is still down over 40% even after this rally. Personally, I love this move because I think the stock is very attractive at these levels. I don't own it. I don't own the stock myself, but I mean, you're talking about a market leader here that is now trading more than 50% cheaper than the broader sector, and that carries a really good dividend of about a 2.3% yield with a double-digit growth rate. Let me know if you guys would want to see a deeper dive on this stock in the future, because it's a stock that I always kind of like to research and talk about and track, and who knows, I might end up investing in them in the future too. But let me know if you guys want a video on them. I feel like I own too many chip stocks as it is, so that's why I don't own it anymore. But let me know if you guys would want a deeper dive on it. Okay, finishing up here with the losers though, there wasn't really anything too interesting this week other than a few stocks that maybe some of you guys might own, some of you guys and girls might own. Like Blackstone, for example, falling over 15% this week. That's one of the world's largest hedge funds, by the way, close to $1 trillion of assets under management. They're very large. And they didn't announce any earnings this week, but instead, the stock probably fell because of the weak economic news, just kind of on a broader sense, leaving them now down about 40% from the top, and their dividend yield at over 5%, although it does carry a very high payout ratio. But that dividend is pretty attractive there at over a 5% yield. But we saw other financial stocks really suffer this week too, so that's why I think it's economic related. But we also saw like Capital One, for example, who fell by about the same amount. And then we also saw a popular auto parts retailer in Advance Auto Parts fall by over 20% this week, as they reported terrible earnings that not only missed estimates, but also they lowered guidance because of the weak macroeconomy, leaving the stock now at a fresh 52-week low after dropping about 40% year to date. They can actually be pretty cyclical, as you can see on this chart here, and that's because of how heavily they are influenced or affected by the macroeconomy. So no surprise here that they're crashing once again, leaving their dividend at the highest level that it's ever been. Might be a good cyclical play if you think the economy is going to recover soon, but I still think it's too risky given the current climate, so I'll be staying away. I just think there's better options out there. Really, all eyes this week though were on the crypto market. I mean, no surprise here. I'm sure you guys have heard of this, but Coinbase stock in particular saw the biggest fall of all these stocks, dropping by over 21% this week, and that was entirely due to the collapse of FTX, who used to be the third largest crypto exchange in the world before it was revealed to be like somewhat of a scam, and it eventually came crumbling down. And now there's multiple other exchanges announcing liquidity issues as people sell out of cryptocurrencies in a panic. As such, Coinbase, which is another crypto exchange, well, they're seeing their stock plummet because of that fear and weakness in the broader crypto market. Personally, I think Coinbase might actually benefit from all of this long term, believe it or not, because I think customers may start using it more if smaller competitors are just going out of business left and right. You know, if people trust Coinbase, then they might flock to it and they might, want to be on there rather than some of these smaller players that are going out of business. But I would say that's mostly speculation on my part, so I wouldn't take that for anything too seriously. Either way, though, Coinbase stock is now down a whopping 90% from the top. Wow, that is a giant crash. And with a PS ratio of only 2 and financials that can sometimes skyrocket depending on how the crypto market performs, I mean, I can definitely understand why some people may want to gamble on it, but it's definitely not for me. I think it's still a little too risky, and I have already enough risk in my portfolio. I own a lot of spec stocks. There's plenty of risk in my portfolio to be messing around too much here in the crypto market as well. I do own some individual coins, but in small amounts, but I do own some Bitcoin and Ethereum, just in case those happen to skyrocket over the long term. I don't want to miss out on that, but that's more so just a very speculative, small kind of play. I'm not looking to invest very heavily in the crypto market, and especially on crypto exchanges that are just a little too volatile, a little too difficult for me to keep perfect track of them myself. And so I'd rather just invest in other stuff that I think is also very attractive. So anyway, that's just how I feel personally, but let me know what you guys are doing. Do you own any of these crypto exchange stocks? Do you own any cryptos? What do you think about the other stocks we talked about in today's video? Is there anything else on your mind? I'd love to hear about it. Let me know down in the comment section. But thank you so much for stopping by and for all the support. It means a lot to me. Hope you're all doing well. Take care. Bye-bye.